In the last month, we have seen a huge bounce back in the market, with the vast majority being very much in the green. And this is after President Trump tried to instate tariffs, but he has recently delayed them. Now, despite the huge run up in the market over the past month or so, we still have some quality dividend stocks trading at a 52-week low. And in fact, every single Monday morning, I get an email from the Dividend Report with news on earnings reports, dividend hikes, and stocks at a 52-week low. And in this video, I want to be looking at 3 of these dividend stocks, and a few of them I actually believe have outsized return potential. So let's go ahead and jump into it. Now, number 1 on this list is going to be Novo Nordisk. If we look at the stock in the last year, it's down almost 48%. And if we look at them year to date, down about 19.25%. Now, if you don't know anything about this stock, I was covering it over on dividendology.com the other day, but this is a global healthcare company based in Denmark, and it's best known for its leadership in diabetes care. You've probably heard of some of their blockbuster drugs, such as Ozempic, which has seen massive growth in recent years. Now, over the last few months, there's certainly been some negative news surrounding this stock. For example, they recently cut their 2025 outlook, and we'll come back and talk about this here in a moment, but I also want to point out that the CEO recently stepped down just a month or so ago. Now, if we look at this company from a dividend perspective, I'll come up here and plug in the stock ticker, and we'll be using the Danish ticker since ticker data can import financials from international stocks. And again, thanks to ticker data, this data will load in, and what we can see is the starting dividend yield is sitting at about 2.5%, but if you look at it on a forward-looking basis, it's actually above 3%. Now, historically speaking, like a lot of European stocks, they've made semi-annual dividend payments, so that is something you need to be aware of. But look at just how much they've grown that dividend in the last few years. The 5-year dividend CAGR is sitting at 21.53%, with a 5-year free cash flow CAGR of 14.4%. So it's clear they've made it a priority to reward their shareholders in the form of dividends. We jump over to the stock screener. I've already plugged the ticker into our profitability sheet, and look at how earnings have grown. Look at how revenue's grown in the last few years. We have a 5-year revenue CAGR of above 19%. And here's what's so beautiful about this business. Look at this profitability ratio. The gross profit ratio last year was nearly 85%. And look at how steady it's been over the past decade. A lot of the times, that is a sign of a competitive advantage. If we jump over to our stock screener, again, let's plug in the ticker. And what we can see down here on the bottom is another clear sign of a high quality company. Return on invested capital, telling us how profitable are the projects the company is investing their capital into. And remember, as a baseline, we typically want to see 10%, above 20%, probably looking at a high quality company. This company is typically around 40% over the last 4 or 5 years. So they're getting incredible returns off the capital they're reinvesting back into the business. So we can see the historical financials paint the business in a very good light, but the stock is still down around 48% in the last year. So let's take a closer look at this bad news. Starting out, cutting 2025 guidance. What exactly does this look like? Well, if we scroll all the way down to the bottom, we can see they lower their 2025 growth outlook for sales and operating profit to 13 to 21% and 16% to 24%, compared to the prior forecast of 16% to 24% and 19% to 27%. Okay, there's a couple of things we have to take note of here. To start off, these are all very wide ranges, so they're not super confident exactly where they're going to land, but they're still very high percentages. I mean, 16 to 24% is great, and we obviously don't want to see the growth projections lowered, but 13% to 21% sales growth is still very, very good. And here's what a lot of people seem to be missing about Novo Nordisk. Yes, Novo Nordisk is currently dominating the market share in their main industry. If we look at GLP-1, they have over 50% of the market share. Now, the huge concern here is Eli Lilly could potentially start taking market share from this company in the next few years. They're developing similar GLP-1 based therapies. But here's what most people are missing. The obesity drug market is expected to exceed $170 billion by 2030, growing at a 32% compounded annual growth rate. That's an even faster growth rate than the artificial intelligence market. So even if Eli Lilly does start to take some market share, the growth in this actual sector is growing at such a high rate, Novo Nordisk is still set to benefit. A rising tide can lift all boats. So their top and bottom lines can still grow at a high rate. So what type of returns can we expect from this stock? Well, if we jump over to the sensitivity analysis and plug in the ticker, Here's what we can see. To start off, come down here. What we can see with ticker data is it automatically pulls in the average analyst's earnings per share estimate through the year 2029. So it takes all the analyst estimates, averages those projections. So what we can do is see the year-over-year growth rates and the projected EPS CAGR through the year 2029. And the projected EPS CAGR for Novo Nordisk is about 14.4%. So that's the middle point based off analyst estimates. Now, this is only one part of determining what our future returns could look like. We also have to enter our projected PE ratio in the future. And like always, I prefer not to be too aggressive with my assumptions. I never want to price in a best case scenario. But what we can see is, historically speaking, this company's had an average PE ratio of around 27.3 over the last decade. But the trailing 12 months PE ratio is only 19.25. So it's trading at about a 29 to 30% discount compared to how it's historically traded. But again, part of this could be justified if Eli Lilly is taking some market share. So let's not assume that it reverts all the way back to the mean. Let's say the PE ratio by the year 2030 is only 22.5. On top of this, let's project an EPS growth rate of around 12. What we can see is by the year 2030, we would all of a sudden be looking at a total return of 130% and a compounded annual return of nearly 15%. And that's not even pricing in a best case scenario. If the GLP-1 market grows as fast as some analysts believe, then I think we could certainly see a higher PE ratio and a higher EPS growth rate from this company. Looking at a discounted cash flow analysis, if we assume a 13% free cash flow growth rate over the next decade for this stock, find the present value of those future free cash flows and add them together, add the company's cash and cash equivalents, and subtract out total debt to get equity value, divide by shares outstanding, we come to a DCF price per share of 512, while the current price is 453. Again, keep in mind, this is in the Danish currency. But what we can see is that means the company's currently undervalued by about 13%, or has about 13% immediate upside. The next company on our list is UnitedHealth Group Incorporated, a stock that has been all in the news in the last few months, and for good reason. In the last year, it's now down around 39%. Year to date, down over 41%, and if we look at the last month alone, down around 28.22%. And this stock has seen more bad news surrounding it in the last year than most stocks will see in a 5 or 10 year time period. I was actually talking about this on Twitter just the other day, but here's the timeline of events. To start off, we saw a massive cybersecurity breach that was labeled as a one-time cost. This was obviously not good for the business from a fundamental standpoint, but not good for business sentiment either. If we jump over to my stock screener, let's come up here and plug in UNH. I've already got it plugged in, and we can see right here, this was the end result of the one-time cybersecurity cost. EPS was growing at a high rate every single year, and then from 2023 to 2024, we saw a stark decline, going from $24.12 all the way down to $15.51. Now, obviously, this is not something we want to see, but this is not weakness of the actual business. Again, this was a one-time cybersecurity cost. So after this happened, they were still projecting 2025 earnings per share to be above 2023. But then we continued to get more bad news. 2025 Q1 earnings missed, which was the first time they had seen that happen in quite a few years. We saw the CEO resign, citing personal reason, and then the company withdrew 2025 guidance, leading the stock to drop another 18%. And then on top of all this, the Wall Street Journal reported that the Department of Justice launched an investigation into Medicare billing fraud, and that was a very big deal, leading to an immense sell-off in the last month. Now, if you aren't familiar with UNH, there's a couple of different things you have to understand about the business. To start off, if we look at them from a dividend perspective, what we can see is UNH now has a starting dividend yield of 2.82%. Now, what's interesting about this is if we look at the historical dividend yield for this stock, it's the highest it's been in the last 5 years. Look at this. It was steadily sitting around 1.5%, and with the market sell-off, it shot up all the way to around 2.5 to 3%. And even in the last 10 years, this is the highest starting dividend yield that the company has ever had. And on top of this, historically speaking, they've grown dividends very predictably at a high rate, with a 10-year dividend CAGR of above 16%, and free cash flow has easily covered those dividend payments, which is still pretty typical for an insurance company. So obviously the huge question is, how does all this bad news change the stock? And really, to put it quite simply, if there was Medicare billing fraud, there's no doubt the stock could go much lower. But there's a couple of things we have to consider. To start off, Look at the insider buying versus selling history for UNH over the last few years. What we can see is in the last few years, there's been a ton of selling. But look at what's happened in the last few months. We've seen 5 separate insider purchases, all from different people, and most notably, we recently saw a huge insider purchase from the CEO himself when he bought around $25 million worth of shares at around $288 per share, and then the CFO did nearly the exact same thing, around $5 million worth of shares at an average price of $291.12. This is obviously a good sign. Now, with that being said, what type of growth is the market currently pricing into UNH? Well, we can actually back into this by using a reverse discounted cash flow analysis. Again, this is going to tell us how much growth the market is currently pricing in. Now, the current share price is around $298, and if we assume 0% growth, they have a reverse DCF price per share of $249,250. So they're not projecting a lot of free cash flow growth in general. If we bump this up to 2%, all of a sudden we get very close to the current share price. If we bump it up just a little bit more, we get nearly identical to the current share price. So what this means is, if we look at the 2024 free cash flow for this company, which remember was lower due to the one-time cybersecurity cost, it was actually lower than it was in 2023, which is not typical. But even with that being said, the market is only pricing in 2.1% annual free cash flow growth over the next decade for this stock. And this is a company that has historically grown free cash flow at a high rate, grown it at double digits. We can see this charted out. It's very clear. Going from around $6.79 in 2014 to in 2023, $27.67. So the market is pretty pessimistic on this stock. I think it's unlikely that they can't grow free cash flow at a rate above 2%, which by that logic would mean that the stock is currently undervalued. So what type of returns can we expect from UNH stock? Again, let's look at the sensitivity analysis. Now to start off, let's look at the average analyst estimate for EPS over the next few years. In 2025, the average estimate is $22.71 per share. Again, let's put that into perspective. We can see in 2022 is around $21.54, and 2023 around $24.12. So the average analyst doesn't expect EPS to get all the way back to where it was in 2023, but they do expect it to be above where it was in 2022. So it'd come in somewhere right here. So overall, yes, they are expecting a little bit of headwind, but it should still be far higher than it was in 2024 due to the one-time cybersecurity cost. And after that, they're still projecting good growth, 15.4, 13.4, 21%, 13%. This gives them a projected EPS compounded annual growth rate of around 15.79% through the year 2029. So the average analyst is still projecting really solid earnings growth for this stock. And on top of this, obviously the PE ratio is at a historic low for this stock due to the massive sell-off we've seen in the last few months. The trailing 12 months PE ratio is only 12.38, when the average PE ratio for the stock is about 22.87 over the last decade. So compared to how it's historically traded, we're looking at a 46% discount. Now, you could argue the lower PE ratio could be justified because they just cut guidance and earnings will drop over the next year, and that is true. But we're not just worried about the next year, we're worried about 5 years from now or even 10 years from now. Now, that being said, again, let's not price in a best case scenario. Let's say that the PE ratio only recovers to around 16.5, which is still considerably lower than the average PE ratio over the last decade. And on top of this, let's go with an EPS growth rate of around 12.5%. What would our results look like? Well, we can see by the year 2030, all of a sudden, our total return is 126.5% with a compounded annual return of 14.6%. So again, this is another example without pricing in a best case scenario, the returns look quite attractive. But I want to reiterate, this all depends on one thing. If there was Medicare billing fraud, all bets are off. This has become a high risk, high reward stock due to that reason. And then lastly, we have Eli Lilly and Company, stock ticker LLY, trading at $722 per share, which definitely puts them on the lower end of their 52-week range. In the last year, down close to around 11%, and year to date, currently down around 6.4%. If we go ahead and look at them from a dividend perspective, I'll plug in the ticker. And what we can see is we're looking at another low yielder that has significantly grown its dividend payments in the last few years, with a 5-year dividend CAGR of above 15%. Now, if you're looking at these other metrics, you're probably a little bit confused. A free cash flow payout ratio of 1,100%, obviously not sustainable. Negative free cash flow, obviously not sustainable. So what's going on with the company? Well, we can see prior to the last couple of years, free cash flow was easily covering those dividend payments. And then in 2023, we had negative free cash flow. And then in 2024, it was slightly positive, but definitely not enough to actually cover the $4.6 billion they paid out in dividends. So what's going on here? What happened? Well, here's exactly what happened. If we jump over to the quarterly data sheet, let's come up here and look at Eli Lilly, and then say we want to look at CapEx per share. And what we can see in the last few quarters, Eli Lilly has significantly ramped up the amount it's spending on capital expenditures. Now, why are they doing this? Well, they're investing into new manufacturing capacity and facilities to support the launch of their upcoming blockbuster drugs. Basically, they operate in the same sector as Novo Nordisk, they're direct competitors, and they see just how much the market is projected to grow over the next decade, and they want to make sure they are poised to take advantage of this. And based off the information we saw around a month ago, it seems to be working out for the company. They saw a huge jump up in share price in pre-market one day last month. They jumped around 14%. As their oral GLP-1 drug succeeded in phase 3 trial. Now we have to remember, with these pipeline companies, there's typically 4 different trial phases, and most of the time if a drug can make it past phase 3, it's typically pretty likely it'll make it past phase 4, meaning it'll be able to hit the market. We have to remember, capital expenditures lowers free cash flow, so this lower free cash flow is a very temporary thing. They're preparing themselves for the next decade. Again, this is a reason why we have to understand what's actually going on with the numbers. What's the story behind them? So does the market expect these high level of capital expenditures to pay off? Well, if we jump back over to Seeking Alpha, let's just look at their analyst earnings estimates. We can see 2025 earnings are projected to grow at a very high rate, 67%. 2026, 2027, 2028. Earning growth rate projections are all extremely high. Let's look at what ticker data is projecting. If we jump over here, we can see I've already plugged in Eli Lilly, and the average analyst estimate has a projected EPS CAGR of 22.43% through the year 2029. So the growth rate projections for Eli Lilly are actually even higher than Novo Nordisk, but the valuation looks quite a bit different. For example, if we look at the forward-looking PE ratio for this stock, it's right now sitting at about 33, which is significantly higher than Novo Nordisk. But again, remember, companies that grow earnings at a high rate deserve higher PE ratios. But even if we look at the historic PE ratios for this company over the last 5 or so years, it's traded at a very high multiple. We can see the forward-looking 5-year PE ratio on average is about 43.09, when right now it's sitting about 33.01. So even with the high PE ratio right now, it's actually still trading about 23% below its 5-year average PE ratio. And like we've already touched on, with Eli Lilly set to take some market share from Novo Nordisk, and with the overall general growth of GLP-1 drug sector, it's easy to see why growth rate projections are so high. People are willing to pay a premium for this stock right now. But even with that being said, valuation is still extremely difficult for this stock, because at the end of the day, it's pretty much going to depend on how much are the capital expenditures going to pay off for this company. High levels of CapEx isn't inherently bad, but if it doesn't pay off, then that's not good for the company. Some companies will get caught in a perpetual cycle of higher than expected capital expenditures, and it can really diminish the company's free cash flow over time, meaning they can't pay out as much in dividends, they can't buy back shares, and they can't strengthen their balance sheet. I don't think Eli Lilly is anywhere close to having that happen, and if we just glance at the balance sheet, we can see they're in a good position with a debt to assets ratio of just 0.43. But the CapEx will be something to keep an eye on. If we look at 2025 guidance from the management team, we can see they're expecting around 32% growth on top lines, 32% revenue growth. So again, like we've already pointed out, they're going to grow at a high rate. And the management team is projecting EPS to be in the range of $22 to around $23.55. So if we jump back over to the stock screener, they're expecting it to jump all the way up to off the chart somewhere up here. So right now, Eli Lilly is definitely an example of a company where the numbers don't paint the full picture. You need to understand what's going on, why the company has higher than expected capital expenditures, why free cash flow is negative. They want to make sure they can take part in the exploding market that they're operating in. So there you go. Those are 3 different dividend stocks that are currently trading right at a 52-week low. Like always, if you'd like to be able to download any of the ticker data spreadsheets and get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.